their upward trend, although little change this morning, up and down, but still above $85 on Brent. So we're Brent near 3-year highs, and WTI, the US benchmark, near 7-8-year highs. So clearly this is a market with continued upward momentum. Let's kick off this morning with Ed Bell, Senior Director at Market Economics at Emirates MBD. Ed, good morning to you. I see in your daily note the concerns presented by the German business confidence index, which is now at a 6-month low. So my question ultimately is that we do seem to be having a divergence. We've got global GDP growth and confidence flattening to declining, and yet markets continue to rise. How much longer can these two things coexist?
Well, I think they can go for quite a while. They're not necessarily mutually exclusive. I think for a lot of firms, a lot of consumers, the fact that oil prices, that energy prices are rising are going to be a concern for confidence and for their investment and spending outlook over the next couple of months. I think with respect to the near-term data that we've been seeing for some of those big developed markets, whether it's Germany or the rest of the Eurozone, the UK, the United States, it's a very familiar tone now of the fact that we are dealing with very elevated input costs, whether that's in terms of material or other overheads like fuel inputs, and also shortages, actual supply chain disruptions. That means people can't get access to the materials that they need for their processes, or labor shortages as well. So I think we can be in for quite a persistent period of elevated energy and oil prices at a time when headline growth is starting to sag.
What about other markets, let's say beyond oil, Ed? What's your outlook for that? I mean, did we see the financial and the equity markets continue to hit records nearly every day? Yet we have this apparent, at least China, certainly other places, where the expected GDP growth is starting to pause. The growth forecast earlier in the year, we saw World Bank, IMF downgrade its expectations.
Yeah, I think we're seeing a couple of different variables at play there. One is that we've had a big reorientation in terms of the fixed income markets, where if you look at US Treasuries, for instance, or UK or other big developed market bond markets, they are pricing a much faster pace of policy normalization. So moving away from zero interest rates, pulling back on asset purchases. We could expect to see an announcement from the Fed as early as in a few weeks' time, when they're going to start to pull that back. I think with respect for equity markets, though, it is still a matter that they are still going to be pricing in the fact that, yes, we are in for a softer patch, a serious slowdown from the very rapid pace of recovery, but if they're going to be pricing in, say, what conditions are like in the second half of 2022, perhaps they're a little bit more sanguine in terms of inflation being able to get under control, labor shortages starting to dissipate, more and more people going back to work. So I think we could still be in a position where equity markets maybe look a little bit of an outlier in terms of pricing and some optimism, even if the economic data for the now, I would say it is slowing down, but it's probably getting us back to trend level growth after the very sharp reaction to the COVID pandemic.
Let's welcome Vandana Hari, founder and CEO of Vanda Insights, sitting in Singapore. Vandana, I'm seeing also in your Vanda Insights newsletter, or views letter, as you call it, the most recent edition, that we're going to see the energy crisis sustain, driving the bullish outlook for oil prices. So my question to you is this energy crisis, quote unquote, so reluctantly to use those terms, but nonetheless they're with us, this sort of driving of prices is in essence a dislocation rather than a demand surge, and OPEC are wise to hold their fire?
Good morning, Sean. I am still in India, not back in Singapore
okay.
yet.
All the better.
Probably, yes. Call it dislocation, or call it the tail wagging the dog. I believe that's the phrase the Saudi energy minister used last week, implying that this is not really a shortage of oil or necessarily extra demand for oil, or that much extra as to justify the rally in prices. as perhaps a reflection of the just generally general bullishness, more so on account of shortages of gas and coal. I do subscribe to that view, and I've been saying that for a few weeks now, that one of the phrases I found probably useful to explain my perspective on this was that oil is being used as a proxy. We do know that the derivatives markets in oil, whether you're talking about futures or in exchange traded products, are far more extensive, more deeper, more accessible to the investor, and we're not just talking about major hedge funds and speculators, but right down to all investors, people like you and me even, than gas and coal. So it is a proxy rally, which is why I've said in my newsletter that first of all, I don't see this energy crisis coming to a quick end, unfortunately, and as a result, because of that, I don't see the oil rally ending anytime soon either.
Let's go to China, where it seems to me in some ways all questions find their answers or lack thereof, but nonetheless, the answer lies in Beijing. Albert Stromquist, principal at Landstrom Advisors. Albert, I think much of the world's outlook at the moment is based on many things, obviously, but one is trying to read the tea leaves on China and its slowdown, and what indeed is it real, the slowdown, and B, what it means for the world. So tackling the first half of that, how real is the China slowdown, the managed slowdown, or is it indeed an imposed slowdown? Your thoughts?
Well, it's I think to a large degree an imposed slowdown. I think the government's been fairly transparent about this. They're not afraid to move off of double-digit GDP growth in transforming their economy from one of an export-driven economic mainstay to more of a domestic consumption economy. That's not going to be an easy transition, but that is certainly part of it.
So I just want to challenge the managed slowdown thesis. I mean, is that a good sort of Madison Avenue spin on what looks like a series of factors that are getting out of control from the Chinese central government, most notably on the property side? Evergrande, of course, the big headline, the China Evergrande Group, but now we're seeing another company, Modern Land, this morning reporting that it has missed a payment on Tuesday, the latest Chinese property developer to do so.
Well, China has a crunch, absolutely, and it's coming from two sectors. One identified here, property, and the other from energy. And these are, I think, own goals. These are planning errors resulting from a dynamic created 2 years ago that's played out over 2020 during a pandemic that no one accounted for in their planning, and then into 2021. With sufficient chaos as to be unable to find the right path forward. So China's left with an energy shortage, and as you probably discussed on previous segments of this panel, with rolling brownouts and blackouts around China, both to the residential and the commercial sector, changes now in the structure of electricity tariffs to commercial consumers and residential consumers. And now plans to reopen 100 coal mines or step up production from 100 coal mines in China with a target of 55 million tons of coal in the fourth quarter, as well as raising imports from.
Have we lost Albert, or have I lost Albert? I think I've lost Albert, and if I have to presume everybody else has. I want to go back to you, Ed, again on looking at this where OPEC and supply goes. We have the Goldman Sachs now forecasting a price for the Q4, although we're at the end of October now, 2 months of this year left. Look, they're putting their target above $90. OPEC Plus seems unwilling, unconcerned to intervene at this point. Do you think that's a risk they're taking, or would you still expect there's a possibility OPEC Plus may look to add more than their 400,000 barrels a month?
Well, I think certainly the commentary that we've seen in the last week from major oil ministers within the OPEC Plus alliance is that they have no inclination to accelerate their pace of supply additions. So for the meeting next week, as it stands right now, even though I would agree with Vandana wholeheartedly that this is not an oil rally. This is oil catching on the back of issues in other energy markets, so being used as a proxy or just trying to draw more oil into the power mix. But I don't expect to see that we'll see any change right now. There was sort of diplomatic pressure, relatively muted ahead of the last meeting at the start of October, which they seem to shrug off quite easily. I don't think that for them, the calculus has changed materially at this point now, and the commentary has been very much to in a way enjoy the prices. We've had comments out from the Saudi energy minister earlier on the weekend here in Dubai not to take the price levels for granted, so assuming that they want to keep on with a relatively, from their point of view, tight oil market. Now, that being said, if they did proceed at least with the 400 KBD per month increase until sort of the end of Q3, as is their plan, we do expect to see a recalibration or a shift into a looser oil market in next year. It doesn't mean that it's going to feel very nice for us in terms of consuming or paying those higher prices over the next couple of months, but at some point during 2022, we would expect to see oil prices correct downward from their elevated levels. And that's also leaving to one side the fact that we could see, which we are still not seeing in a meaningful way a positive supply response from outside of the OPEC Plus alliance. So from producers in the United States, potentially to increase output quite considerably. I think all the major forecasting agencies still are expecting that at the end of next year, US oil production is going to be higher than it was at the end of 2019. There is some.
We certainly see that in the backwardation in the market, that supply coming in. But Albert, I wanted to come back to you just to finish that point, the idea that China, the kind of own gold scenario that you were outlining. You're on mute, Albert. Sorry, you're on mute. You're on mute. Unmute. Unmute, as they say.
Here.
There we go. There we go. There we go. There we go.
If you lose me, it's an internet problem here.
Yeah.
No, I think there's been inadequate planning for power capacity in China based on a model that was moving the country away from coal-fired generation on a deliberately set path toward more of a renewable contribution to the country's power. That renewable is still there and is growing very fast, but demand recovery post-COVID here has put stress on power generators and has led to shortages of critical fuels. Coal accounts for 65% power generation in China. So that has really been kind of the.
Are there, Albert? Sorry to interrupt. Are there any other own goals? Clearly, the real estate one is whether it's own goal or not is grabbing all the headlines at the moment, and the construction industry as a whole in China is massive. I've read research that indicates it's even as big as 30% of the GDP when you extrapolate all of its supply chain parts. Are there any others that we're not seeing yet that you, being on the ground, may have a little sniff on that might offer the next Evergrande, the next sector to be possibly concerned about?
Sean, nothing I have seen that compares to the property sector and the energy sector. Right? They are overwhelmingly critical now to China's short-term, mid-term economy. I haven't seen any. I'm happy to report them to you if I have any breakthroughs.
Okay. Vandana, the other aspect that seems to be giving the oil markets, if they needed another upward motion, is the outlook for the winter. You had called that as a concern in your Vandana Insights earlier last week. It does look like La Nina is giving us an earlier and colder winter in the Northern Hemisphere.
It does seem like that. Again, we all need to take weather forecasts with a pinch of salt. We know that. But
a pinch of salt on your ice road, perhaps, and then you'd need larger than a pinch. But yes.
Yeah. and I was myself, it's fascinating how El Nino and La Nina actually work, right? But apparently, so in the Atlantic as well, and the US is also under La Nina, but from what I understand so far, correct me if I'm wrong, and any of you have more insights into this, but it's expected to bring warmer winter weather to the US. However, if you look at the Pacific Ocean, La Nina is expected to bring much colder than normal weather across, of course, eastern China. And
which it is already doing,
Correct.
doing.
Exactly. So I believe Korea has had its first snow a good fortnight before what is normal. So, all of that is driving. I do.
It all matters though, does it, Vandana? Because at a tight market, you would say maybe these fluctuations wouldn't be as significant. But in this window of time, when it's $35 per MBTU of LNG into Japan, that's a big deal.
It is, but again, I do myself wonder if it is simply another strand that fits very nicely into the bullish narrative that because for the longest time, what we've been reading is what if, we have all of these problems, and what if the winter in the Northern Hemisphere turns out to be colder than normal? Do you still have me?
Vandana, sorry, you're cutting in and out. Maybe turn off your camera and we'll get the audio better on its own.
Okay. Shall I continue? Fingers crossed.
Yeah, please. Yes, please.
Yeah. No, I was just finishing up with the thought that I think also the what if scenario of what if we get a colder than usual winter has just fit very nicely.
Still losing half of the world. Sorry, Vandana, we're still losing half in and out. If you could do a quick log out, log in, maybe. Ed, one of the questions that seems to be on the market is, I've heard on the ground here in the Middle East that the idea that, well, $100 oil didn't kill the world economy last time, so as a percentage of its burden on global growth, etc., we can go for a higher price. We could go for that triple-digit number. Your thoughts on that thinking, whether it's bedding in the region, and B, whether it actually has validity?
Well, I'm not sure that it necessarily has enormous amounts of validity. I think there would be a lot of pain being felt in economies that are still in early door recovery mode from the COVID-19 pandemic. Many economies that are that feel the pinch of higher energy prices much more acutely. I don't think would be really welcoming $100 oil at a time when their economies are still under-vaccinated and they're still not roaring in terms of what we've seen in the past. I think what's important to stress, though, is that while we might look at, from our perspective here in the GCC, that $100 oil price is great somehow, because that means that fiscal balance sheets get repaired, that you can have budget surpluses. The actual trickle through in terms of the domestic economy that we've seen from higher oil prices during the past few cycles has been negligible. Governments here have really focused on trying to repair balance sheets rather than trying to stimulate growth in terms of spending that or adding to capital expenditure. So it's something that we stress to our clients, is that yes, the oil prices are going up, and that looks good from the headline perspective of the balance of payments and the fiscal balance sheet of this government, of governments in the region, but it doesn't necessarily mean that it's going to support growth or allow more. This could be just a lot more money that goes into a sovereign wealth fund that invests elsewhere outside of the region.
Albert, given the current dislocation, we're seeing the reports of up to 1 million barrels of oil, extra oil demand currently because of the switching away from gas and LNG, given the cost of gas for power generation. I'm wondering from Asia perspective, from China perspective, this current window of dislocation, both on the extra call on coal, the move away from gas or LNG, or an attempt to, what's the legacy potential of that, do you think, at a time in which we have been, at least in China's case, moving, it would appear, firmly towards a kind of a greener outlook, let's say? Does this disrupt that? Does this, if the Chinese president not going to COP26, where is that, these current trends impacting China and Asia's commitment to go more into the transition?
I believe that China in particular has a sincere desire to move the country toward a green goal. Right? However, they're not going to do that in any way that compromises their economic security, the social welfare of the people in particular, and in more important matters such as defense and R&D. So, yes, there is a commitment, but today we're moving backward, right? Particularly in China, toward more tolerance particularly for carbon emissions, and I don't see that changing quickly. I think we'll be looking at maybe 1 to 2 years before China can begin to plan aggressively toward carbon reduction.
Where does that, Albert, intersect with the challenges China has vis-a-vis aging demographic, stressed water resources? You say the economic well-being, they won't compromise it, but yet obviously the cost of health and management, etc., from the high carbon economy is significant.
Well, these are all great questions. Look, food security is another one as well. So China is going to walk a narrow fence here to.
Uh-oh, I think we're losing Albert again, unfortunately, at a very critical point. You're nearly suspicious, the timing. Albert, sorry, we lost you again on that point. You're on mute.
I'm back now. We're having great deal of trouble here with this call today, Sean. So I lost my train of thought.
Yeah, we were just talking about how the Chinese outlook for some of you talked about the idea that they won't compromise on economic growth, and so carbon will remain center, but yet they do have big challenges from the aging demographic, from water stress. So the cost of those things are quite significant.
Well, in fact, yes, the increased carbon consumption and emissions here is going to lead, particularly in North China, to more disease this winter, more respiratory disease, greater health demand on the healthcare network, all of that. So it's a self-feeding cycle that can only be broken when there's truly a move away from carbon emissions.
Which I've always thought has been the sort of driver in China. It's not that they have some green sort of sensitivity. It's just the burden of the carbon economy on its health system is quite massive. Let's go to the survey question and then go to sort of final thoughts. The disrupted supply chains and higher input costs, inflation, are contributing to the sagging confidence in continued global GDP growth. We sort of talked about that at the outset with Ed. Will soaring financial markets continue to rise regardless? And that's across the financial assets and equities and others, that even though we've got disrupted supply chains and higher input costs and inflation, and that GDP is continuing to plateau and decline, but regardless, financial markets will continue to rise. A yes or no? Welcome your thoughts on that. Vandana, you said, and it's great that at the beginning that you are sitting in India. Perhaps you can give us some outlook on the Indian recovery from what was, it seemed, an early, without using somewhat morbid sort of language, a near-death experience in the second quarter this year. I mean, it was a medieval plague that had knocked over India. Now, 6 months later, it seems to be soaring again.
Yeah, so socially, from what I can see, that chapter has been firmly put behind. And the country is moving on. I mentioned that earlier on your show as well. The oil demand is once again rebounding. It's probably 98% of 2019 levels, and the country is now entering the festive season, which in here, lasts for several weeks. So around which time I wouldn't be surprised to see oil demand even climbing back up to 100%. There is still a little bit of tentative feeling. People are generally being cautious. The government is advising a lot of caution as well, because The wave hasn't come back, but that doesn't mean that it can't come back. So, and just very quickly to finish my earlier thoughts, I think as far as the bullish narrative on oil is concerned, right now it's just very difficult to poke any holes in it. All the possible relief valves are tightly shut, OPEC, non-OPEC production being one, and, US or China releasing SPR is another, all of those have been ruled out. I do feel, however, I think it's important to keep in mind there are still some downside risks. Nobody's expecting the Nord Stream 2 right now to get German approval very, very quickly, but you never know, miracles do happen. And if that happens, I believe, we could see this rally fizzle out very quickly. If it turns out to be a warmer weather, Northern Hemisphere winter as well, I think we could also see prices climb down much before they reach, 90, let alone $100 a barrel. On your survey question, I said yes. So I think financial markets will continue rising. The Q3 results of companies have been quite good. And the financial markets are completely disregarding, as you were mentioning earlier, the headwinds to economic growth, the deceleration that is happening. If and when the Fed and the ECB start tapering, I think that's what will give the financial markets a reality check.
Let's get the survey result and get Ed a last word this morning. Will the soaring financial markets continue to rise regardless? An overwhelming answer there, Ed. Looking on that point, the consequence of inflation, is it indeed the scale of the concern that it is? The Fed now seems to be a laggard on that. The UK seems to be a little bit more on the front foot. Your thoughts on the impact and the outlook for inflation to impact monetary policy?
I think it's going to be a question of what the kind of reaction is, particularly from the Fed, if they're willing to actually go against the new strategy that they adopted last year, which tolerates periods of higher inflation to make up for periods of past inflation. I think there is this fear that we're going to enter into the kind of wage price spiral period that we had in the 1970s, when that really derailed growth and caused inflation in the United States to run close to 10%. We are a long way from that. And certainly in terms of just employment compensation, the fact that you can have many of these big firms afford to be able to hire people at higher wages, I think refers to or highlights the fact that wages had been depressed for such a long period, particularly in sort of lower income or lower skilled positions.
Well, the minimum wage, the federal minimum wage of the U.S. is still $7.50 an hour, and has been.
There is enormous scope to increase wages, to pass it on. Yes, we're in for a period of high inflation that's going to be exacerbated by the impact of higher energy costs right now. But if that leads to higher income for workers and that inflation gets passed through, maybe it's going to be a 12-month process. I personally, from an economist point of view, don't view that as a negative.
And just to close, Ed, we are sitting on the doorstep of what appears to be the delivery of the U.S. spending, the Biden spending bill. Yes, diminished in scale, but still expected to be over $1 trillion. How does that play into this narrative?
I think it's important to remember that's not $1 trillion, even if that's the number that comes out the day it gets approved. That's going to be phased out over many, many years to try and establish a much more sustainable level of growth in the United States. So while there could be some inflationary impacts, particularly from the infrastructure element of that kind of spending, that's investment that's going to be happening in the nearer term, say a 6 to 12-month horizon. But the bigger long-term social plans are the ones that are going to be spread out over a much longer time frame and should have more of a negligible inflationary impact.
Negligible, but nonetheless, the sentiment it delivers, I do think, keeps the whole narrative moving upward. I mean, the idea that Amazon's trying to hire 100,000 people, offering sign-on bonus, they can't even find them, and that's before you even start to repair the bridge outside your back garden. It does look like that's a lot of upward momentum for the U.S. economy and hence financial assets. So one to watch how it's passed and the scale of it. but that could be the news before COP kicks off next week, according to Biden. But we'll have to wait and see. Thank you so much. It's great, Albert Stromquist, to always get your views from the ground in China, even if the internet gremlins can come in and play their part. Vandana Hari from India, great to have your insights this morning. The world's two biggest countries per population and biggest in many other ways, probably biggest festivals, one would think as well, Vandana, from what I've seen, and more of them coming, although last year they did deliver, it would appear at least, played a part in that wave of COVID that came afterwards. So let's hope this time it doesn't happen due to a higher vaccination rate. Ed Bell, as always, from Dubai, your insights are great to have. Thanks, everybody. Have a great day. Oil prices this morning opening in Asia, little change would be the headline, but lots of noise around that little change. All the best. Thank you.
Thank you, Sean.
Thanks.